Section 4, the carry trade. So let's understand this through an example. Say we are working with two currencies, the US dollar with a relatively low interest rate or low yield, and the Pakistani rupee with a relatively high interest rate or yield. And let's say that initially we have a spot rate of rupees 60 per dollar. So the rupee is the price currency and the dollar is the base currency. According to uncovered interest rate parity, the rupee is going to lose value and the dollar is going to gain value. So looking at it another way, if an investor takes a dollar, sells that dollar to buy rupees, so he will get rupees 60, and if the investor then invests at the relatively high interest rate, let's say that the rupee interest rate is 12%, and let's say that the US dollar interest rate is 2%, according to uncovered interest rate parity, what's going to happen is over 1 year or over whatever period of time, even though the investor can earn 12% on the rupee, but the rupee is going to lose value relative to the dollar, and that loss in value will essentially balance out this interest rate differential. So that's what uncovered interest rate parity says. Now, enough studies have shown that uncovered interest rate parity does not always hold. And a classic example can be seen here. So this graph shows us the PKR to US dollar exchange rates since January 2000 till now. So notice this period here between 2002 and 2008. The exchange rate is fairly stable at rupees 60 to the dollar. Even though during this time there was a substantial difference in interest rates. So if an investor took dollars and used those dollars to buy rupees and invested at the Pakistan interest rate, he could make a substantial sum of money because the dollar was not appreciating based on uncovered interest rate parity. So clearly there was a profit to be made during this period. And this trade that I just referred to is called the FX carry trade, where an investor would take a long position in the high yield currency. So in my example, the investor would buy rupees and a short position in a low yield currency where essentially the investor is selling US dollars. So sell US dollars to buy rupees, invest at the relatively high yield in the rupee, and then eventually convert back to US dollars. And if the exchange rate has remained stable, clearly this is a profitable strategy. So studies have shown that investors can actually make lots of gains doing this, and those gains happen if there isn't much volatility in the exchange rate. However, there is a huge risk. So if an investor saw the stable exchange rate between 2002 and 2008 and decided to engage in this carry trade over here, he would make a huge loss, because after 2008 the dollar appreciated and the rupee depreciated very fast. So clearly this strategy would have resulted in significant losses, and these large losses are referred to as crash risk, because if as happened over here, if the rupee suddenly starts losing a lot of value, then clearly this FX carry trade will result in substantial losses. So those losses are referred to as crash risk. Now, given this fact that if you do engage in a FX carry trade, you are likely to have many small gains and a few large losses, then your returns are likely to look something like this. Let's say this is the zero level. There will be lots of small returns and a few large losses. So your return will be negatively skewed, and you will have a fat tail. So just take this as a given. With FX trades, you have your return profile has a negative skew and fat tails. Another core point about the carry trade is that it is essentially a leveraged position where you borrow in the funding currency, which in my example is the US dollar, and you invest in the high yield currency, which in my example is the PKR. Now, leverage, whenever you take a leverage position, this will magnify the gains and losses. So the more of this you do, the higher the gains, as long as your exchange rates are relatively stable. But when exchange rates change rapidly, as we see over here, in other words, when volatility is high, then because of leverage, the losses are also going to be substantial. So these are the core points. Now what you must do is example 8, and based on what you've heard here, it should be fairly straightforward. In example 8, question 5 is a calculation, which again is fairly straightforward based on all the material we have learned so far. It is just a mechanical calculation where you are calculating the profit based on a FX carry trade. The explanations for example 8 in the curriculum are also quite good. So make sure you do this one well. We'll now cover section 5, the impact of balance of payments. I'll give you the core points, and then your job will be to do example 11, which is at the end of this section. So balance of payments, as you've seen at level 1, essentially consists of the record of all transactions that a country makes with other countries. And simplistically speaking, balance of payments can be broken into two parts: the current account and the capital account. In level 1, we studied this in a fair amount of detail, but here at level 2, we are just looking at current account and capital account rather simplistically, and focusing on the impact of current account and capital account surpluses and deficits on currency appreciation and depreciation. So let's take the current account. The current account balance represents the sum of all recorded transactions in traded goods, services, income. So this is income received, for example, on foreign investments, and net transfer payments such as remittances. A persistent current account deficit typically leads to currency depreciation in the long run, and a persistent current account surplus typically leads to a currency appreciation in the long run. Now again, one needs to emphasize that this relationship is not contemporaneous, which means that it doesn't happen immediately. So just because a country is running a current account deficit doesn't mean that its currency will immediately depreciate. The current account balance must be matched by an equal and opposite balance in the capital account. So the capital account consists of all the investment and financing related flows. At level 1, we studied this in a little more detail, where we thought of the capital account as a financial account and a capital account, and this distribution was based on the nature of assets. But right now we are not going to worry about this subtle distinction. In the short to intermediate term, investment/financing flows influence exchange rates. So this is a high-level remark that we'll discuss in more detail on subsequent slides. Now let's look at how current account imbalances impact exchange rates. And to understand this segment, let's recall the expression that we studied in section 3.3. So we said that the real exchange rate is equal to the equilibrium long run exchange rate plus the difference between real interest rates minus the difference between the risk premium of the domestic currency relative to the foreign currency. This can be rewritten using a slightly different set of symbols. Here L refers to low yield and H refers to high yield. So if we take a simple example where the low yield currency is the US dollar and the high yield currency is the Pakistan rupee. So, Pakistan rupee here then becomes the base currency. This expression essentially is the same, only we have replaced F with L and D with H. This expression can then further be decomposed into this, where the Q bar, which is the long run expected exchange rate, is staying the same. The difference between real exchange rates based on parity relationships that we've studied earlier can be rewritten as the difference between nominal interest rates minus the difference between the expected inflation rates, and then the difference between the risk premium is simply brought down. So hopefully this formula makes sense and you can memorize it, or you actually just need to memorize this formula and then everything else follows. If expected inflation rate increases, so let's take a situation where the high yield currency, which is the Pakistan rupee, if this currency, if the expected inflation goes up, then what will happen? If expected inflation goes up in the high yield currency, that means this number over here goes up. If this number goes up and all else equal, given that we have a minus sign over here, the real interest rate difference will go down. If the real interest rate difference goes down, that means the real exchange rate will go down. So real exchange rate going down means that the base currency, which is the high yield currency, the PKR in this example, will lose value or depreciate. So that's core point number one. The second point you need to know is that when we have difficult economic times, then investors will generally try to move towards safer currencies, which in this example would be the US dollar, which is the low yield currency. So the demand for low yield currency goes up, and this impacts the risk premiums. So what's going to happen over here? The risk premium that investors would demand now for holding the Pakistani rupee, which is the high yield currency, will go up. If this number goes up, then notice what happens to the real exchange rate. So if this number goes up, then the real exchange rate goes down. In other words, the high yield currency, which is the Pakistan rupee here, will lose value. If there is an economic boom in the high yield area, so if there's an economic boom in the high yield, so in Pakistan, then the real exchange rate will rise in the short run. So these core points will help you with example 11. One more point before you do example 11. There have been several studies that try to look at the correlation between equity returns and exchange rates. And what has been observed is that the correlation between equity returns and exchange rates are unstable in the short term, but they tend towards zero in the long run. So in the long run, correlations are effectively zero, but in the short run, there is no clear pattern. Now, with the basic information that we've discussed and using some common sense, you should be able to do example 11. Once you read example 11, it is useful to set a context, and you will notice even though the curriculum uses general terms such as emerging market country and developing market country, it is quite clear from the example that the emerging market country is China and the developed market country is probably the United States of America. So if you can put this in your mind as you solve this problem, it will be relatively straightforward. Plus the solution, the explanations for this example are really good. Make sure you spend time on it and understand it well. Section 6 deals with monetary and fiscal policies and how they impact exchange rates. The first and most basic model that we'll study is the Mundell-Fleming model, and this essentially describes how monetary and fiscal policy impacts interest rates and economic activity, and then this in turn will impact exchange rates. Let's look at different scenarios. The first scenario is expansionary monetary policy with flexible exchange rates. So when you have a expansionary monetary policy, this essentially means that interest rates are lowered. So lower interest rates will result in capital outflows. So with lower interest rates, capital will leave your economy. Capital outflows essentially means that your exchange rate, let's just denote that as S, will go down. So the exchange rate goes down, your currency depreciates or loses value. Expansionary fiscal policy with flexible exchange rates. The basic idea here is expansionary fiscal policy means that spending is relatively high. High spending results in deficits. Deficits will result potentially in higher interest rates. Higher interest rates means that capital will flow into your economy. So capital inflows. Capital inflows means that the exchange rate will strengthen. So your currency will appreciate. So the curriculum has taken this excerpt from Rosenberg, which shows the impact of expansionary policy, expansionary monetary policy, as well as expansionary fiscal policy. So note that expansionary monetary policy and restrictive fiscal policy will result in the currency depreciating. A restrictive monetary policy and an expansionary fiscal policy, so expansionary fiscal policy as we discussed here, coupled with a restrictive monetary policy will result in the domestic currency appreciating. And these other two areas are ambiguous. So expansionary monetary policy coupled with expansionary fiscal policy will have an ambiguous impact on exchange rates. And here also the impact is ambiguous. The curriculum says a lot on this, but as long as you understand the core points I've covered here, that's good enough. The key is to recognize that when interest rates go down, then the exchange rate goes down or the currency weakens, and when interest rates go up, then the currency strengthens. Now let's look at expansionary monetary policy with fixed exchange rates. So here again, interest rates go down. When the interest rates go down, the exchange rate falls or the domestic currency depreciates. But what the central bank will try and do here is buy the currency in FX markets in order to maintain the peg, and this buying of currency in the FX markets to some extent offsets the depreciation. But typically the currency will still depreciate. Expansionary fiscal policy with fixed exchange rates. Now, to prevent the domestic currency from appreciating, the central bank will have to sell its currency. So selling of the currency actually will mean that the exchange rate will come down. So in the FX markets, if there is a high supply of the domestic currency, then that brings exchange rates down or the currency depreciates. So note that with the expansionary monetary policy and expansionary fiscal policy, given that we have fixed exchange rates, the currency will depreciate. So that's what we see in this table over here. Expansionary monetary policy and expansionary fiscal policy cause the domestic currency to depreciate. Then the rest of the blocks or cells in this table become obvious. Restrictive monetary policy and restrictive fiscal policy will cause the currency to appreciate, and these two cells are ambiguous. Moving now to section 6.2, monetary models for exchange rate determination. In this model, we basically assume that output is fixed and monetary policy impacts exchange rates primarily through price levels and inflation. And our basis is the quantity theory of money, which we studied at level 1. The quantity theory of money basically says that the price level times output is equal to money supply times velocity. If we assume that the output is fixed and velocity is stable, then an increase in money supply will result in a similar increase in price level. And then if we assume purchasing power parity, then increases in price level, or essentially this means inflation, will result in changes in exchange rate. So when price levels go up, then your nominal exchange rate will go down. And according to this model, the real exchange rate, so the real exchange rate stays the same. This model simplistically assumes that purchasing power parity holds, and as we have studied earlier, purchasing power parity does not necessarily hold in the short run or the medium run. So we'll now look at a slightly more sophisticated model, which is called the Dornbusch overshooting model. According to this model, price levels are inflexible in the short run. So any increase in the nominal money supply will result in an increase in the real money supply. An increase in the real money supply will cause interest rates to come down. When interest rates come down, then both the nominal exchange rate comes down and the real exchange rate also comes down in the short run. In the long run, this model matches with what we talked about earlier, where the exchange rate will converge to the level predicted by purchasing power parity, and the real exchange rate will converge to the equilibrium level. Next, we'll talk about Taylor rule and determination of exchange rates. Most central banks conduct policy via interest rate targets. So up till now, essentially, we've been talking in terms of money supply, but the fact is that most central banks conduct policy via interest rate targets. And the Taylor rule is an interesting framework that allows us to estimate the interest rate that will be set by the central bank. So here is a formula that you need to memorize. The I stands for the nominal interest rate that the central bank will set according to this Taylor rule framework. Rn refers to the neutral real policy rate. By neutral, we mean the rate that will create neither expansionary pressures nor any recessionary pressures. Pi refers to the current inflation rate. Alpha and beta are coefficients, which for simplicity now we will just take as 0.5. Pi, as I already discussed, is the current inflation rate. Pi star refers to the central bank's target inflation rate. Y refers to the log of the current level of output or GDP, and Y star refers to the economy's potential or sustainable level of output. So if this number is positive, that means that inflation is relatively high. If this number is positive, that means that the economy is overheated and the output currently is more than potential GDP. To help you memorize this formula, let me just give you some basic numbers. So imagine scenario 1 where the economy is in equilibrium and the current inflation rate is equal to the target inflation rate and the output is equal to potential GDP. So the economy is stable and at equilibrium. In that case, the interest rate set by the central bank is simply the current neutral real interest rate plus the inflation. Now let's say that the economy gets overheated, there is relatively high inflation, and the output is greater than potential GDP. So let's say inflation is 2% higher than the target inflation level, and let's say that even this number is positive, so the economy, the output is more than potential. So notice that in this case, given the 0.5, the positive coefficients, the interest rate that will be set will be higher than simply Rn plus inflation. And you can see that it is logical that if the economy is overheated, then the prescribed interest rate will be higher than Rn plus n. On the other hand, if these numbers are negative, then the interest rate will be relatively low, which will be a mechanism of boosting the economy. What we've seen so far is a mechanism to predict interest rates, but Taylor rule can also be extended to predict exchange rates. And I'm going to skip the details and just give you the intuition behind this formula that has been derived in the curriculum, and this is not as bad as it looks. So I'm just going to interpret the key elements and then share with you what the curriculum says. So we are looking here at the real exchange rate of the euro. Since euro is the base currency, so our focus is on the euro. As we've discussed earlier, Q bar refers to the equilibrium exchange rate. So effectively what we are saying is that each of the following will strengthen the euro relative to the dollar. First, an increase in the market's estimate of the euro's long-run equilibrium value. So that's this number over here. An increase in the market's estimate of euro's long-run equilibrium value will increase the real exchange rate, all else equal. The second element, an increase in the ECB, this is the European Central Bank. So ECB's estimate of the policy neutral real interest rate relative to the Fed's estimate of the policy neutral real rate. So remember from our previous slide, Rn is the policy neutral real interest rate. So this differential over here is the differential that's being referred to in bullet referred to over here. So if this differential increases, then that causes the real exchange rate to go up. In terms of the coefficient alpha, for simplicity, let's assume again that that's 0.5. An increase in the inflation gap, that's the inflation gap in the euro area. So an increase in this inflation gap relative to the inflation gap in the US area will cause the real exchange rate to go up. Let's assume that this coefficient beta is also 0.5, and this is referred to as the output gap. So if the output gap in the Eurozone is relatively high compared to the output gap in the US, that also will cause the real exchange rate to go up. And finally, a decrease in the risk premium demand for holding euro-denominated assets relative to the risk premium on dollar-denominated assets will cause an increase in the exchange rate. Section 6.4 talks about monetary policy and exchange rates, historical evidence. I think this is an interesting read, but not very testable from an exam perspective, so I'm going to skip it. Example 12 is absolutely critical. You need to go through this very carefully. I'll just highlight a couple of points to help you go through example 12. The first point is that expansionary fiscal policy leads to economic growth. So we've seen this briefly at level 1. Expansionary fiscal policy means relatively high spending or relatively low taxation that will boost consumption, which will boost aggregate demand. When you have relatively high aggregate demand, the equilibrium level of output is above potential GDP or potential output, and that leads to inflationary pressures. So we've already discussed that briefly, but I just wanted to make sure that you have this in mind as you approach example 12. And the other point, which is rather obvious, but still I want to remind you, that central bank only controls monetary policy. The fiscal policy is controlled by the government. So with those additional points, you can now attack example 12. Section 6.5, fiscal policy and determination of exchange rates. So the most important aspect of this segment is that we combine the Mundell-Fleming and the portfolio balance models. The Mundell-Fleming model helps us in the short run. So if we look at expansive fiscal policy, what happens in the short run? Effectively, there's an increase in the real interest rate differential. So as we saw earlier, when you have an expansive fiscal policy, interest rates go up. So when interest rates go up, then that means the interest rate in your economy is relatively high, capital flows in, so that results in your currency appreciating. So this is in the short run. The portfolio balance model helps us with the long run response. If the country has an expansive fiscal policy, there will be a budget deficit. If there is a persistent budget deficit, then the government debt will build. So with the government debt increasing, one of two things can happen, or actually both these things can happen. One is the government or the central bank can monetize the debt. What this means is the central bank can just print more money or increase the money supply to pay off the debt. And when that happens, when there is an increase in the money supply, the currency will depreciate. The other way of looking at it is that outsiders looking at the relatively high deficit will conclude that the government will eventually need to change its fiscal policy and move into a more restrictive stance. So that restrictive stance is going to decrease the interest rates, which in turn will cause the currency to depreciate or lose value. So these are the core points. Now what you need to do is example 13, which essentially tests you on the points that we just talked about. Section 7, exchange rate management, intervention and controls. To make this segment more interesting, imagine that you are the head of the central bank of an emerging market or emerging market country. The question now is, how should you deal with a major surge of capital flow into your economy? So let's say your economy is doing well and investors from the developed world want to pour money into your country. So there is this surge in capital flows. Is this good or bad, and how do you deal with it? So in terms of whether these surges are good or bad, evidence suggests that these capital flow surges can either be a blessing or a curse. Why a blessing? Because let's say that in your country the investment requirement is high, but domestic saving is relatively low. In this situation, the capital flow will bridge the gap between the investment requirement and the domestic saving, and in this sense, the surge in capital flow is a good thing. However, as has been seen in the Asian currency crisis in the late 90s, or with the Mexican peso crisis in the mid-90s, sometimes a surge in capital flow can fuel a boom in currency prices and asset prices, which set up the economy for a bust. Now, where do the surges in capital flow come from? And we need to recognize that these surges are driven by a combination of pull factors and push factors. Pull factors have to do with variables within our economy. So on this, I would suggest that you take a careful look at the 12 bullet points at the start of this segment. So essentially, if good things are happening in your country, for example, the economic management by policymakers is good, if we expect declines in inflation rates and declines in inflation volatility, if we have a relatively flexible exchange rate regime, and so on, these will result in pull factors which cause capital flows to come into your country. Push factors have to do with what's happening outside your economy. So, for example, very low interest rates in Japan might encourage investors to take money out of Japan and put into your economy. So, that would be a push factor. The next question is, how do you deal with surges in capital flows? So we've already talked about whether it's a blessing or a curse, but we need to know how to deal with these surges. And here is what the IMF recommends. If your currency is undervalued, then you should let the money come in. In other words, you should allow your currency to appreciate. As we have seen before, if there is a high demand for your currency because of these capital flows coming in, that would cause your currency to appreciate. However, obviously we need to be cautious about the currency appreciating too much. But at this level, let's just say that if undervalued, then according to IMF, it is okay to allow your currency to appreciate. If your currency is fairly valued or overvalued and there is no inflation threat, then the IMF recommends unsterile intervention. Expand the monetary base. The expansion of the monetary base will cause interest rates to go down, and if interest rates are going down, then what will happen is money will flow out, and that will put a downward pressure on the exchange rate. If your currency is fairly valued or overvalued and there is an inflation threat, then the IMF recommends sterile intervention. And what this means is that the central bank should sell domestic securities to the private sector. When this happens, the central bank is mopping up liquidity. So in essence, when capital flows are coming in, that is causing money supply to go up. But because of this mopping up of liquidity, we balance out this increase. In other words, we reduce the monetary supply because we are buying securities from the market. Now, essentially what happens then is interest rates remain more or less unchanged. If the net effect on the monetary supply is that it's not changing, then the interest rates remain more or less the same. Inflation rates remain more or less the same. If intervention fails to accomplish your objectives, then you can consider capital controls. The objective here is to limit the increase in value of your currency and increase in value of asset prices. So the key point here as a policy maker is to consider whether or not capital controls will actually work. And evidence suggests that the success of capital controls depends on the magnitude and persistence of inflows. So if the capital inflows have a very large magnitude or they are persistent over a relatively long period of time, then capital controls generally do not work. So with these core points, you now need to do example 14 from the curriculum. Section 8, Currency Crises. The first core point made in this section is that if we look at currency markets over the last couple of decades, investors and credit rating agencies have generally failed to predict currency crisis episodes. So again, if we look at the Mexican peso crisis or the Asian currency crisis, these were not predicted by either investors or credit rating agencies. There are several different opinions about the causes of a currency crisis, but the two major schools of thought are as follows. First, that currency crisis is precipitated by the deterioration of economic fundamentals. The other thought is that a currency crisis can occur out of the blue and hence is extremely hard to predict. According to this school of thought, sudden shifts in market sentiment can cause a currency crisis, and those sudden shifts are hard to predict. The other cause can be contagion, where issues in one country can just flow over to another country, even though the economic fundamentals of the other country are reasonably sound. So the larger point is that given historical data, it is very hard to predict the coming of a currency crisis. Having said that, given the huge impact that a currency crisis has on the world economic system, lots of studies have been done to try and develop some form of early warning system. So what would be the characteristics of a good early warning system? First, it should have a strong record of predicting actual crises, and the system should also avoid frequent issuance of false signals. So if you have a system that does a good job of predicting a crisis, but at the same time it keeps raising false alarms, then that's not very good. So ideally we want a system that does a good job of predicting and also doesn't raise false alarms. Number two, the system should be based on macroeconomic indicators whose data are available on a timely basis. So ideally we want a situation where the data can be analyzed and this data can be used to predict what will happen in the future. In other words, contemporaneous or lagging indicators don't really help us. And finally, a good warning system should incorporate a wide range of systems that crisis-prone currencies might exhibit. Now, the output from, or the core points from IMF study on this subject is presented in the curriculum, and these are the indicators, potential sets of indicators for a currency crisis. I would encourage you to read this a few times and then attempt example 15 from the curriculum. The final segment, short-term forecasting tools. Fundamentals-based models have limited success predicting short-term movements, hence the use of technical analysis, order flow, sentiment, and positioning. With technical analysis, the core premise is that upside and downside moves in currency rates happen in a systematic manner. So they recur in a systematic manner. So proponents of technical analysis try to look at charts of currency prices over a period of time and then use those charts to try and predict what will happen in the future. So evidence suggests that technical analysis techniques were reasonably profitable between 1973 and 1995, but they have had limited success after that. There has been some success in emerging markets, but not a whole lot. So essentially what the curriculum concludes is that technical analysis does not allow you to make abnormal profits. However, technical trading rules can help you manage the risk of excessive positions and crash risk of carry trades. We've talked about crash risk of carry trades in earlier segments, so I will not repeat here. Or the core point is that while trading rules do not allow you to make abnormal profits, they can help you manage currency risk. In terms of order flow, sentiment, and positioning, the core point here is that there is a positive contemporaneous correlation between trends in order flow, sentiment, and positioning. So these items on the one side and exchange rates or trends in exchange rates on the other side, there is a positive contemporaneous correlation. So these items and exchange rates move up and down together. So while that's good, but the problem is that this relationship is contemporaneous. So since this relationship is contemporaneous, it doesn't really help us predict anything. So if we see positive sentiments or high order flows or high level of positions, then the exchange rate is moving at the same time. We can't say that sentiment is positive and therefore exchange rate will go up in the future, because positive sentiment will result in exchange rate going up contemporaneously or at the same time. So let's take each one of these items separately. And what I'm going to do is simply give you the core point from these segments in the curriculum. With order flow, the core point is that you can look at all the order flows you want, but from an investor perspective, you will see that there is mixed evidence on the predictive power. So just because you know order flow information, you cannot predict currency rates in the future. As far as sentiments are concerned, sentiments in the FX market are measured using a option instrument called a risk reversal. The curriculum briefly tries to explain what a risk reversal is, but I don't think we need to get into it. You can just think of it as a product that's based on currency options. So the point is that risk reversals can confirm a exchange rate trend but cannot predict it. Again, this is based on the contemporaneous relationship. So when you see a positive sentiment for a given currency, that positive sentiment will be happening along with the increase in exchange rate. So again, the confirmation is good, but it doesn't help us predict future exchange rates. And finally, positions. So positioning, this refers to your position in a given currency. So changes in net speculative positions, again, do not help us predict exchange rates in the future. So these are the core points. You need to do example 16, which is based on these points as well as items that you have studied before. That brings us to the end of this extremely long reading.